What if everything you've been told about the US economy is only half the story? For the past few years, headlines have screamed recession. Inflation surged to levels not seen in decades, interest rates skyrocketed, banks failed, government debt exploded past $30 trillion, experts predicted collapse, analysts warned of a crash, social media declared the end of the dollar, and yet, the economy didn't fall, not in 2022, not in 2023, not in 2024. So here's the real question. Why hasn't the US economy collapsed yet? Is it stronger than we think? Or is something quietly holding it together? Tonight we uncover the real forces keeping the system alive and what could happen next. ACT1 origins, the shock that should have broken it. In 2020, the global economy froze, businesses shut down, markets crashed, unemployment skyrocketed. The US government responded with trillions in stimulus. Meanwhile, the Federal Reserve slashed interest rates to near zero and injected unprecedented liquidity into the system. Money flooded financial markets, stocks surged, crypto exploded, housing prices soared. But there was a cost. By 2022, inflation hit 40-year highs. To fight inflation, the Federal Reserve did something dramatic. It raised interest rates at the fastest pace in modern history. Historically, rapid rate hikes break things. And something did break. In 2023, Silicon Valley Bank collapsed almost overnight, triggering fears of a banking contagion. Panic spread. Commentators declared, this is the beginning, but it wasn't. Why? Act 2, the rise, the hidden pillars holding it up. Despite everything, the economy kept moving, the labor market shielded, unemployment stayed historically low. Consumers kept spending. During the pandemic, households accumulated excess savings, stimulus checks, paused student loans, and rising asset prices created a financial cushion. Even as inflation squeezed budgets, spending continued. And in America, consumer spending drives nearly 70% of GDP. As long as Americans spend, the machine runs. Corporate adaptation. Companies adjusted quickly. They refinanced debt when rates were low. Many locked in cheap borrowing for years. So when rates rose, the immediate impact was delayed. This is critical. The pain didn't disappear, it was postponed. Government deficit spending. While households slowed down, the federal government stepped in. Massive infrastructure spending, defense budgets, and industrial policy programs injected new money into the economy. In effect, public spending replaced weakening private demand. The system stayed afloat. The AI stock market effect. Just when markets seemed vulnerable, a new narrative emerged. Artificial intelligence. Companies like Nvidia led a historic rally. Tech stocks soared. Market indexes climbed. This created a powerful psychological effect. When the stock market rises, confidence rises. When confidence rises, spending continues. The wealth effect is real, and it helped delay collapse. Act 3, the breaking point that never came. Economists expected 3 possible breaking points: housing crash, banking contagion, consumer demand collapse. None fully materialized. Housing slowed, but supply shortages kept prices elevated. Banks stabilized after emergency liquidity support. Consumers reduced excess savings, but wage growth offset some of the pressure. In other words, every time stress appeared, a counterforce responded. It's almost as if the system has built-in shock absorbers, but here's the twist. Shock absorbers don't remove impact. They absorb it temporarily. Act for what's really happening under the surface. The economy hasn't collapsed, but cracks are visible. Credit card debt is at record highs. Commercial real estate faces structural pressure from remote work. Small businesses struggle with higher borrowing costs. Government debt continues expanding at an unsustainable pace, and interest payments on that debt are rising fast. The system is stable, but increasingly fragile. Think of it like a bridge under heavy weight. It hasn't fallen, but the strain is increasing. Act 5, the dollar factor. There's another reason collapse hasn't happened. The US dollar remains the world's reserve currency. Global trade, commodities, and central bank reserves are heavily dollar-based. This creates constant demand for US assets. It gives the US unique financial flexibility, but reserve status is an advantage, not a guarantee. Confidence sustains it, and confidence can shift. ACT 6, the psychology of delayed doom. One of the most misunderstood economic forces is timing. Recessions don't always happen immediately after rate hikes. Historically, they often arrive 12 to 24 months later. Monetary policy works with lags, which raises an uncomfortable possibility. Maybe the collapse isn't cancelled, maybe it's delayed, or maybe the definition of collapse has changed. Instead of a dramatic crash, we get slow growth, persistent inflation, rising inequality, asset bubbles, a slow grind instead of a sudden fall. Act 7, the new economic model. There's a growing belief that the modern US economy operates differently. Central banks intervene faster, governments spend more aggressively, financial markets respond instantly to liquidity. Some argue we've entered an era of managed capitalism where crises are contained before they spiral. But containment has a price: higher debt, more intervention, greater systemic complexity. The longer collapse is avoided, the larger the imbalances may grow. Conclusion: so why hasn't it collapsed? Because of massive fiscal intervention. aggressive central bank action, strong labor markets, AI-driven market optimism, global dollar dominance, delayed monetary policy effects. The economy hasn't collapsed yet, but stability does not equal strength. Sometimes the most dangerous phase isn't panic, it's calm, because calm breeds complacency, and complacency builds risk. The real question isn't whether the economy will collapse tomorrow, it's whether the current system can sustain growing debt, rising interest costs, and structural shifts without breaking something bigger. History shows economies don't collapse when everyone expects them to. They collapse when confidence quietly erodes. So watch confidence, watch liquidity, watch credit markets, because the next chapter of the US economy may not look like a crash, but it could feel like one. If you found this analysis valuable, subscribe for deeper breakdowns on finance, markets, and economic power structures. The story isn't over, it's just unfolding.